Welcome to the Stock Guy Analysis. Okay, let's just dive right in here. You're looking at a number that frankly shouldn't exist in a corporate filing, especially not for a company that started out mining cryptocurrency, right? When we were going through the sources for today's deep dive, the one thing that just jumps off the page is the scale. A request to increase authorized shares from 500 million, which is already a lot. It's a huge number on its own, all the way up to 50 billion. That's a 100 times increase. Just stop and think about that scale for a second. It's unprecedented. Exactly. And your first gut reaction, especially if you come from traditional finance, is pure panic. You see 50 billion, and your brain immediately screams death sentence. And historically, that reaction makes sense. For a normal struggling company, issuing shares like this is a sign of distress. It means debt problems, shrinking margins, and printing stock just to keep the lights on. That's the definition of destructive dilution. So we need to set that tension up right away, because here's where it gets interesting. We're in the crypto markets, and we're dealing with a company sitting at the intersection of decentralized finance and hard infrastructure. In this space, the normal rules don't always apply. Precisely. This request isn't necessarily panic. Our sources suggest this is actually the foundation for one of the most aggressive financial maneuvers we've ever seen from a public company in this sector. This part is critical. If you see that headline and sell purely out of fear of dilution, you may be missing the entire plot. So today, our mission is simple. We're breaking down what our sources are calling the 50 billion share war chest for BitMine. A war chest, not a bailout fund. And we're going to walk through 3 distinct paths they could take to turn this paper capacity into billions in hard assets. Because from everything we're seeing, this move isn't about paying an electric bill. As one source put it, this is about planning a hostile takeover of the future. Let's get into opportunity number 1, the Ethereum Fortress. The idea here is using this capital capacity to acquire a massive strategic position in Ethereum. And we're not talking about buying ETH just to sit on the balance sheet. This is about becoming a major institutional player in Ethereum's validation layer. A big one. Let's clarify something important for the listener. That 50 billion number is authorization, not issuance. They're not printing all of this tomorrow. Exactly. The sources suggest they'd only need a small fraction. Issue enough stock to raise about $1 billion. That's the operational war chest. And at current prices, $1 billion buys roughly 250,000 Ethereum. 250,000 coins removed from the market. But the real magic isn't just owning ETH. It's the infrastructure they already have. The MAVAN project, their in-house staking validated network. They're not handing coins to Coinbase. They're staking internally. They control the keys. They capture all the yield. That's the difference. Staking turns ETH into a productive asset. You lock it up to secure the network, and the network pays you yield in new ETH. With their own validator tech, they maximize efficiency and control. That's where perpetual cash flow starts. Let's run the numbers. A conservative 4% staking yield on 250,000 ETH produces 10,000 ETH per year. That's new ETH generated annually. At today's price, around $4,000. That's $40 million per year. Pure, non-operational cash flow. But now consider the upside. If ETH hits $15,000, as suggested by forecasts like Tom Lee's, that same yield becomes $150 million annually. Same coins, same yield, different outcome. That's when the entire financial structure changes. But wait, the initial $1 billion raise still causes dilution. You can't avoid that. True, but it creates a self-correcting flywheel. With $150 million in annual cash flow, you can fund operations and initiate stock buybacks. So dilution is used once to build the machine. Then the machine buys back more shares than were issued. Exactly. BitMine stops being just a miner. It becomes a yield-generating investment platform. Now let's shift gears to opportunity number 2, the valuation game. The AI infrastructure pivot. This starts with their name, BitMine Immersion Technologies. That word, immersion, matters. The bottleneck in AI isn't chips. It's heat. Next-gen GPUs run too hot for air cooling. Immersion cooling is the only efficient solution, and BitMine already does this. They have the facilities, the expertise, and the permits. Here's the arbitrage. Crypto miners trade around 5 times earnings. AI data center companies trade at 20 times to 50 times earnings. Same infrastructure, different valuation. Hosting AI compute generates roughly 10 times more revenue per megawatt than Bitcoin mining. So they raise capital, convert capacity, sign AI contracts, and force a market re-rating. Short-term dilution. Long-term multiple expansion. That's financial judo. Which brings us to opportunity number 3. The hybrid flywheel, what sources are calling God mode. Step 1. Raise capital and acquire ETH. Step 2. Stake it internally. Now you have predictable decentralized yield. Step 3. Use that ETH yield to fund AI infrastructure. The decentralized asset funds centralized expansion. Ethereum becomes the bank vault. AI becomes the revenue engine. The balance sheet holds yield-producing crypto. The income statement holds high multiple AI revenue. The risk profile completely changes. So here's the real takeaway. Those 50 billion shares aren't dilution. They're fuel. Temporary dilution to acquire permanent assets. What looks like distress in the old system is aggressive growth in the new one. The real question isn't why they're diluting. It's what they're about to buy. A hostile takeover of the future. And that's a perfect place to leave it. Thank you for watching.